If you are a US farmer, you may have wondered how Brazil has gained so much ground in recent years. One key reason is lower production costs, which make Brazilian soybeans very competitive in global markets. In this video, we'll look at why Brazil's soybean costs are lower than those in the US and what American farmers could do to offset this gap. I am Joana Colussi, a research assistant professor in agricultural economics at Purdue University, and this is Purdue Commercial AgBrief's quick research-based insights to support better farm management decisions. Stay with us, and before you get started, don't forget to like and subscribe for more updates. Brazil and US together account for almost 70% of global soybean production. In a recent study, we compared the soybean production in both countries using agri benchmark data from 2020 to 2024. We compare one typical farm in Iowa with another in Mato Grosso, Brazil. Agri benchmark enables global comparisons by using farm models that reflect typical production systems and their share of national output. From 2020 to 2024, direct input costs accounted for more than 60% of total expenses on a typical farm in Mato Grosso. This was pushed mainly by high spending on fertilizers and crop protection products. In Brazil's tropical environment, the need for chemical pest control and fertilizers to correct soil gives these inputs a large share of total costs. By contrast, overhead costs represent the largest cost component on the typical U.S. farm, accounting for nearly half of total costs over the same period. This is mainly due to higher land costs, which have increased a lot in recent years. Meanwhile, overhead costs account for 25% of total costs on the Brazilian farm. Overall, total production costs remained higher on the U.S. farm than on the Brazilian farm, even though Brazil had sharp cost increases beginning in 2022. During this period, total costs on the Brazilian farm nearly doubled, driven primarily by higher direct input expenses, for example, fertilizers. Soybean production costs also increased on the U.S. side, but at a slower pace. From 2020 to 2024, total costs on the U.S. farm rose by about 13%. Despite rising production costs, soybean revenue on the Brazilian farm generally kept pace with costs after 2020, supported by strong soybean prices. Then, profitability remained positive in Brazil. In addition to exchange rate effects, strong international demand, especially from China, supported Brazilian producers. That was not the case on the U.S. farm. Returns were more volatile, with losses in 2020 and again in 2024. Financial pressure on U.S. farms has intensified since 2023, reflecting higher input costs, lower margins, and increased reliance on operating debt from previous years. Looking ahead, Brazil's expansion into lower-cost frontier regions, combined with continued infrastructure improvements, could further improve its cost advantage. For U.S. farmers, staying competitive will depend on improving productivity, managing costs, and reinforcing risk management in an environment of uncertain input prices. You can read more about this comparative study in a recent article published on the Purdue Center for Commercial Agriculture website. We'll find the link in the description below. Thanks for watching Purdue Commercial AgBriefs. Subscribe for more research-based insights, and we'll see you next time.